Welcome back, students and scholars. In this first episode on ASC 230, Statement of Cash Flows, we are building the cash flow map. The key idea is simple: follow the cash, not just the profit. Net income tells us what accounting recognized under accrual rules, but the statement of cash flows tells us where cash actually came from and where it went. In this video, we will focus on the three main activity buckets: operating, investing, and financing. Do not worry, we are not preparing a full statement yet. Today we are building the foundation, because if classification is weak, the full cash flow statement becomes like a GPS with no signal. Technically present but not very helpful. Here is our learning path. First, we will understand the purpose of ASC 230 and why the statement of cash flows is so important to financial statement users. Second, we will clarify the cash focus, what enters the statement and what stays outside the body. Third, we will learn the three activity buckets: operating, investing, and financing. Fourth, we will discuss judgment traps and the predominant principle for cases where a cash flow has features of more than one category. Direct method, indirect method, and full statement preparation are coming in later videos. For now, our job is to master the classification logic because every later calculation depends on this map. Why do cash flows matter so much? Because profit answers one question, but cash answers another. Net income is shaped by accruals, estimates, depreciation, amortization, revenue recognition, expense matching, and many other accounting rules. Cash flow cuts through that and shows the raw cash movement. Users want to know whether the entity can generate future cash, pay debt, pay dividends, fund operations, and explain why net income differs from cash generated during the period. A company can report profit and still struggle for liquidity. That is not theory. That is exactly why lenders, investors, auditors, and analysts read the cash flow statement closely. Cash is not the only truth, but it is a very stubborn witness. ASC 230-10 is the overall subtopic for the statement of cash flows under US GAAP. It provides the broad rules for classification, presentation, and disclosure. Business entities preparing a complete set of US GAAP financial statements generally need a statement of cash flows, and many not-for-profit organizations also apply the requirements in general purpose reporting. This video is focused on the foundational rules that apply broadly. Some scope exceptions and industry-specific differences exist, and we will mention those when relevant in later lessons. For now, remember this: ASC 230 is not just a mechanical statement format. It is the standard that tells us how to explain cash movement in a disciplined way. The statement of cash flows reports cash movement only. It is not an income statement and it is not a balance sheet. The statement captures cash, cash equivalents, restricted cash, and restricted cash equivalents in the beginning and ending totals. Cash includes currency and demand deposits. Cash equivalents are short-term, highly liquid investments that are readily convertible to known amounts of cash and have insignificant risk of value change. Restricted cash is cash whose use is limited by legal or contractual terms. Accrual-only items like accounts receivable, depreciation, and deferred revenue do not enter the body as cash flows by themselves. They may affect reconciliations or disclosures, but they are not cash movement. Accounts receivable can wear a cash-looking costume, but ASC 230 will still check its ID. Cash equivalents need a clear policy. Not every short-term investment automatically qualifies. To be treated as a cash equivalent, an item should be highly liquid, readily convertible to a known amount of cash, and generally have an original maturity of 3 months or less from the date of purchase. It should also be held as a temporary investment of idle cash, not as a strategic investment position. Common examples may include treasury bills, commercial paper, and money market funds when the criteria are met. Equity securities and longer maturity instruments generally do not qualify. The important discipline is consistency. Once an entity defines what it treats as cash equivalents, That policy should be applied consistently across periods, because changing the cash boundary casually can distort trend analysis. Now let us separate cash transactions from non-cash activities. AST 230 excludes significant non-cash investing and financing activities from the body of the statement because the statement body is for actual cash receipts and cash payments. But non-cash does not mean unimportant. A bond conversion, a finance lease acquisition with no cash paid at inception, or a purchase partly financed by a seller note can materially change the balance sheet. These transactions are disclosed separately, usually in a supplemental schedule or notes. If a transaction has both a cash part and a non-cash part, only the cash portion enters the statement body. This is a big exam and practice point. Economic significance alone does not make something a cash flow. Now we come to the three cash flow buckets. Every cash flow needs a home: operating, investing, or financing. Operating activities are generally linked to the entity's principal revenue producing activities and items that enter net income. Investing activities are tied to long-lived assets, loans made and collected, and investment securities. Financing activities relate to owners and creditors, issuing shares, borrowing money, repaying debt principal, and paying dividends. This three-bucket model is the heart of ASC 230. When you see a transaction, ask two questions. First, did cash move? Second, which activity explains the purpose of that cash movement? If you answer those two questions correctly, most classification problems become manageable. Operating activities usually connect to net income and the core business cycle. Common operating inflows include cash collected from customers for goods and services, and certain other cash receipts that do not belong in investing or financing. Common operating outflows include cash paid to suppliers, cash paid to employees, cash paid for income taxes, and generally cash paid for interest under US GAAP. Operating cash flow is especially important because it helps users judge whether the main business is generating cash from normal activities. A company may raise cash through borrowing or asset sales, but if operations consistently consume cash, users will ask harder questions. Operating cash flow is like the business engine sound. If it coughs every period, someone should open the hood. Investing activities reflect cash tied to productive assets and investments. Cash paid to acquire property, plant, and equipment is an investing outflow. Cash received from selling equipment is an investing inflow. The full proceeds from sale go to investing activities even if a gain or loss appears in net income. Loans made to others are investing outflows, and principal collections on those loans are investing inflows. Purchases and sales of investment securities are also generally investing, subject to specific guidance and exceptions. The investing section often tells users whether the entity is expanding, replacing assets, selling assets to raise cash, or shifting its investment portfolio. In short, investing activities show where the entity is placing or recovering longer-term capital. Financing activities explain cash from owners and creditors. Cash received from issuing shares is a financing inflow. Cash received from issuing bonds, notes, mortgages, or other borrowings is also a financing inflow. Cash paid to repay debt principal is a financing outflow. Cash dividends paid to shareholders are generally financing outflows for the issuing entity. The major trap is confusing debt principal with interest. Repayment of principal is financing because it returns borrowed capital to creditors. Interest paid is generally operating under US GAAP because it is treated as part of the cost of obtaining resources and is tied to income measurement. If principal and interest are mixed into one mental bucket, the cash flow statement becomes messy very quickly. Some cash flows have features of more than one category, and that is where judgment matters. ASC 230 uses a two-step approach. First, check for specific guidance in ASC 230 or another ASC topic. If specific guidance exists, follow it. If no specific guidance applies, classify the cash flow based on the predominant source or use of the cash flow. That means we look at the main economic purpose, not just the label on the transaction. Consistency also matters. Similar transactions should be classified consistently across periods unless a valid accounting reason supports a change. Changing classification just because this year's presentation looks nicer is not judgment. That is accounting cosmetics, and reviewers usually do not appreciate cosmetics in cash flow classification. Let us now mark 4 classification traps. First, interest paid is generally operating under US GAAP even though it relates to debt. Second, debt principal repayment is financing, not operating, and it must be separated from interest. Third, asset purchases such as equipment are investing, while routine repair and maintenance cash payments are operating. The distinction depends on whether the cost is capitalized or expensed. Fourth, non-cash conversions such as debt converted to equity or assets obtained through finance leases with no cash paid at inception stay out of the statement body and go to supplemental disclosure. These traps are common because the words sound similar, but ASC 230 cares about the cash movement and its economic purpose. Let us close the foundation. The first takeaway is cash focus. The statement reports cash, cash equivalents, restricted cash, and restricted cash equivalents. Accrual items do not enter the body by themselves. The second takeaway is the 3 activity buckets: operating, investing, and financing. Every cash flow must be classified. The third takeaway is that non-cash investing and financing activities are disclosed separately, not ignored and not forced into the body. The fourth takeaway is judgment. Apply specific ASC guidance first, and when specific guidance is absent, use the predominant source or use principle consistently. If this lesson helped you, please like it, share it with your colleagues, subscribe to Commerce Regiment, and support the channel so we can keep building serious free education. In the next video, we will move to the direct method and indirect method, where operating cash flows are presented using 2 different routes to the same operating cash result.